Hi, Tim Karen from Mortgage Choice in Kingsley. I just wanted to give you a bit of a market update. There's some strange things happening at the moment and they're worth talking about. But first, another thing that's worth talking about is our $20,000 cash competition. So if you settle a home loan by the end of June this year, you're in the running to win $20,000. The fine print here says that the home loan needs to be at least $150,000 and it needs to be for a purchase or a refinance. But you can also do it if you get a car loan through us. So there's that, but what I wanted to talk about was what's going on with interest rates at the moment, and particularly with investment interest rates. We had two banks last week of all the lenders on our panel announce that they are no longer accepting refinances of investment debt. And to clarify what that means, the government essentially divides residential home loan debt in Australia into two broad categories. One is for investment and one is for owner-occupied. Investment is obviously if you're buying an investment property or shares or something like that with the money you borrow. And owner-occupied applies to if you're buying the house you live in, or if you're making improvements to that, or if you're buying a car or something else with the money that doesn't count as investment. So when we apply for home loans, we need to let the lender know which of these purposes the funds are being used for, and different lenders process that in different ways. What happened last week is that the two of the lenders on our panel decided that anything that's classed as investment debt and is being refinanced to them is an application they can literally no longer receive. Why is that happening? The way to understand that is to backtrack a couple of years and look at what's been going on in the market to bring us to that point. So the first thing that happened is the government was getting quite concerned back in the middle and second half of 2015 about the rate of foreign investment in Australian property, particularly in Sydney and Melbourne, which had seen growth of something like 15 to 20% over the year leading up to that point. So what they did is they said, okay lenders, you break debt, residential home loan debt into owner-occupied and investment. From now on, you're not allowed to increase the amount you do for investment debt by any more than 10% a year. Now that affected different lenders differently. Some of them had to completely stop lending to investors entirely. One lender simply pulled out of the market. Most other lenders responded by increasing their interest rates on investment debts, which is why if you had a home loan for investment purposes a couple of years ago, you might remember your rates suddenly going up. Since then, rates have dropped a bit, and as lenders have gone by and as the new financial years have ticked over, lenders have gone, right, we can meet our certain quota of expansion of our investment lending portfolio again this year, so they price their loans again competitively to do so. So fast forward to what's happened now. These two lenders that have stopped receiving investment refinances have simply reached the point where if they don't, they're breaking the rules. If they still receive those investment refinances and do those deals, they're breaking the rules. Leading up to that point, they had put their interest rates up for investment refinances, and that should have meant that less people want to go there. I certainly stopped referring my clients there once the interest rates got expensive and we looked at other options instead. But clearly that hasn't worked enough. There's obviously enough investment lending going on that they've had to pull out of the market completely. So from now on with those lenders, until they change their policy again, you can only get investment debt with them if you are purchasing a property. So that's the first time I recall seeing that happen in that way, which is a pretty interesting development. So where that's placed us at the moment is that right now a good deal on an owner-occupied debt might be somewhere under 4%, around the 3.85 to 3.9 mark for most people that qualify for a loan like that. If you have a lot of debt, you can get it a bit cheaper. If you have less debt, you can get it a bit more expensive. But for investors, a good deal at the moment is around the 4.3 mark or something like that, or even maybe a little bit more or a little bit less depending on the situation. So there's a significant gap now depending on the purpose of the debt. That's been the case for the last couple of years, but that's the first time in the 13 years that I've been a mortgage broker that that has been the case. So we're in a different environment now, and I think based on the way the rules are now, that environment is probably here to stay. If I had to make a prediction about how 2017 is going to go, I'd say rates are going to be changing all the time depending on how close or far away lenders are from meeting their quota of growth of investment by no more than 10%. I think for an investor, if you've got a significant amount of investment debt, that probably means you need to be on the ball and you need to be talking to someone like me on a regular basis and just checking that what you've got makes sense. because I think the way lenders can make money in an environment like this is to gradually put rates up on existing debts until you get to the point, hopefully, where you don't notice and you don't bother to refinance. But yeah, every now and then I speak to someone who's not paid attention for 4 or 5 years to the debt they've got, and suddenly they realise they're paying sometimes 1%, 1.5% more than they need to, and changing lenders can save them thousands and thousands of dollars. So if you've got investment debt, or you know someone who has and they're not happy with the rate, let's have a chat and let's see if there's any other options. That's it for now. I hope that helps, and I'll talk to you next time.